You're scrolling through financial news and you see this. Bull run continues as blue chips surge on high volume. Analysts warn of overbought RSI levels and potential correction. PE ratios near bubble territory. What? Exactly. The stock market has its own language, and nobody teaches it to you before you start investing. So you either guess, or you Google every other sentence, or worse, you just don't invest at all. Today, we're fixing that. I'm going to walk you through every major stock market term you need to know, from the basics all the way to things like short squeezes, the VIX, and Fibonacci retracements. No jargon left behind. Let's get into it. What even is a stock? Let's start from zero. A stock is a unit of ownership in a company. That's it. When you buy one share of Apple, you literally own a tiny piece of Apple, its products, its profits, its future. Each unit of that ownership is called a share, and the person who holds it is called a shareholder. Now there are two main types of stock: common stock and preferred stock. Common stock is what most people buy. You get a slice of profits and usually the right to vote on big company decisions, like who sits on the board. Preferred stock works differently. You typically don't get voting rights, but you receive fixed, predictable dividends, and if the company ever goes bankrupt, preferred shareholders get paid before common shareholders. Think of it as the safer, quieter cousin of common stock. Now, companies that want to sell their stock to the public do so on a stock exchange, the marketplace where all buying and selling happens. The two biggest in the world, the New York Stock Exchange and Nasdaq. Think of them like massive digital auction houses running every weekday. To access them, you need a broker, a platform or person who places trades on your behalf. Today, brokers are mostly apps like Robinhood, Fidelity, or eToro. Some charge a commission, a small fee per trade, though many are now zero commission. Every company on the exchange has a ticker symbol, a short code that represents them. Apple is AAPL, Tesla is TSLA, Google is GOOGL. It's basically a nickname the stock market gave every company. And when you own multiple investments, stocks, funds, anything, that whole collection is called your portfolio. Here's where things start getting interesting. A bull market is when prices are rising and investor confidence is high. Bulls attack by charging upward, same direction as prices. Bull markets usually come with strong economic growth and optimism. A bear market is the opposite. Prices are falling, typically 20% or more from recent highs, and pessimism takes over. Bears swipe downward. Prices go with them. Between those two extremes, you get a correction, a drop of around 10% from recent highs. Corrections are actually normal and healthy. They cool off prices that have risen too fast, and they're not the end of the world, even though they feel dramatic. A crash, on the other hand, is a sudden, severe collapse, often triggered by panic, economic shocks, or unexpected global events. Crashes can wipe out months or years of gains in just days. Volatility describes how wildly a stock's price swings. High volatility means big, fast moves, up and down. Low volatility means steadier, calmer movement. Tech stocks tend to be more volatile. Utility companies, much less so. Volume is the number of shares traded in a given period. High volume usually signals strong investor interest. Low volume can mean the market is uncertain or just quiet. Liquidity tells you how easily you can buy or sell a stock without dramatically moving its price. Apple? Extremely liquid. Millions of shares change hands daily. A tiny company you've never heard of. Much harder to exit quickly. And market sentiment is the overall mood of investors. Are they optimistic? Fearful? Somewhere in between? Sentiment can drive markets just as much as actual company performance. Sometimes more. Okay, so now you can see a stock. But how do you know if it's actually worth buying? You look at the numbers. Revenue is the total money a company brings in from selling its products or services, before any expenses come out. Think of it as the raw fuel the business runs on. Net income is what's left after every bill is paid. Salaries, rent, taxes, interest, all of it. This is the real profit, also called the bottom line. Earnings per share, EPS, takes that net income and divides it by the number of shares. So if a company earns $100 million and has 50 million shares, EPS is $2. It tells you how profitable the company is on a per-share basis. The PE ratio, price to earnings, is one of the most widely used valuation tools. It compares the stock price to EPS. A high PE might mean the stock is expensive or that investors expect big growth ahead. A low PE might mean it's undervalued or that it's struggling. Context matters. The PEG ratio adds one more layer. It's the PE ratio divided by the expected earnings growth rate. A PEG under 1 can signal good value. The stock is cheap relative to how fast the company is growing. Book value is what a company would theoretically be worth if you sold every asset and paid every debt. It's a conservative snapshot of the company's net worth, and the price-to-book ratio compares the stock price to that figure. Free cash flow is the cash a company has left after covering its operating costs and investments. It's the real money available for things like paying dividends, buying back stock, or funding growth. Profit margin tells you how much of each dollar in revenue actually becomes profit. A 20% profit margin means the company keeps 20 cents from every dollar it earns. Return on equity, ROE, shows how effectively a company turns shareholder money into profit. High ROE typically signals strong, efficient management. And debt-to-equity ratio reveals how much a company borrowed versus how much shareholders invested. Too much debt can be risky, especially when the economy slows. Not all stocks behave the same way, and knowing the different categories helps you build a smarter portfolio. Blue-chip stocks are the giants: Apple, Coca-Cola, Johnson & Johnson. Large, stable, time-tested companies. They may not double overnight, but they tend to hold up through rough markets. Growth stocks are companies expected to expand fast, often tech or innovation-driven. They usually reinvest profits instead of paying dividends. Early Amazon or Tesla are classic examples. Value stocks are companies the market has underpriced. Value investors believe the stock is trading below what it's truly worth, and they're waiting for the market to catch up. Dividend stocks pay shareholders a portion of profits on a regular basis, usually quarterly. Great for people who want steady income from their investments. Cyclical stocks rise and fall with the economy. Airlines, hotels, and car companies tend to boom when times are good and struggle when they're not. Defensive stocks are the opposite. Companies that people need regardless of the economy. Food, utilities, healthcare. These tend to stay stable even during recessions. Penny stocks trade at very low prices, usually under $5. They can be tempting because they seem cheap, but they're highly risky and often poorly regulated. Tread carefully. Speculative stocks are bets on future potential. A biotech with one big drug in trials, or a startup chasing a breakthrough. The upside can be massive. So can the downside. Stocks aren't the only game in town. An ETF, exchange-traded fund, is a basket of assets, stocks, bonds, commodities, packaged into a single investment you can trade like a regular stock. Instant diversification, usually low fees. A mutual fund works similarly, but it's professionally managed and priced once per day at market close rather than traded throughout the day. A fund manager decides what goes in and what comes out. An index fund is a type of ETF or mutual fund that simply mirrors a market index, like the S&P 500. No guessing, no active management. It just tracks the market, which keeps costs low and makes it a favorite for long-term passive investors. A hedge fund is a private, aggressively managed fund that uses complex strategies, shorting, leverage, derivatives, to chase high returns. These are generally only open to wealthy investors because of their high risk and high minimums. A REIT, Real Estate Investment Trust, lets you invest in real estate without buying any property. These companies own income-generating real estate like office buildings, malls, or apartments, and they're required to pay most of their profits as dividends. A bond works like a loan, but you're the lender. You lend money to a company or government, they pay you interest over time and return the full amount when the bond matures. Bonds are generally more stable than stocks and are often used to balance a portfolio. Commodities are raw materials: oil, gold, wheat, natural gas. They can be bought directly or through funds. Cryptocurrencies like Bitcoin or Ethereum are digital assets that operate outside traditional financial systems, highly volatile and speculative. When people say the market is up today, they're usually talking about one of these. The S&P 500 tracks 500 of the largest US publicly traded companies across all sectors. It's the most widely used benchmark for the overall US market. The Dow Jones Industrial Average, or DJIA, covers just 30 major companies, but they're household names: Apple, Boeing, McDonald's. It's one of the oldest and most recognizable market indicators in the world. The Nasdaq Composite tracks over 3,000 companies listed on the Nasdaq exchange, heavily weighted toward tech. If you want to know how the tech sector is doing, watch the Nasdaq. The Russell 2000 tracks 2,000 small-cap companies. It's a useful pulse check on smaller domestic businesses and early-stage growth. The VIX, also called the Fear Index, doesn't track stock prices. It measures expected volatility in the S&P 500. When the VIX spikes, investors are nervous. When it's low, the market is calm. It's not about direction. It's about how bumpy the ride is expected to be. When you hit buy on your broker app, you're placing an order. But there are different types, and they matter. A market order is the simplest. Buy or sell immediately at whatever price the market is offering right now. Fast. But the exact price isn't guaranteed, especially in a fast-moving market. A limit order gives you control. You set the price you're willing to pay or accept, and the order only goes through if the market hits that number. If you want Apple at $185, but it's trading at $190, your limit order waits. A stop-loss order is your safety net. You set a trigger price below your purchase price, and if the stock drops to that level, it automatically sells, limiting how much you can lose. A trailing stop is a smarter version. Instead of a fixed price, it follows the stock upward as it rises. If the stock climbs from $100 to $120, your trailing stop climbs with it. When the stock drops suddenly, it sells, locking in gains. A day order expires at the end of the trading day if it's not filled. A good till cancelled GTC order stays open until it's either filled or you manually cancel it. Useful if you have a target price but don't want to babysit the market. A fill or kill FOK order must be filled completely and immediately, or it's cancelled. Used mostly by large institutional traders who need full execution right away. People invest in wildly different ways. Here are the main camps. Passive investing means buying broad funds and holding them without constantly trading. The most popular version is dollar cost averaging, DCA, investing a fixed amount at regular intervals, regardless of price. This smooths out volatility over time. Active investing means trying to pick winners or time the market. More effort, more risk. Buy the dip means purchasing a stock after a price drop, betting it'll recover. Buy and hold is exactly what it sounds like. Buying quality companies and holding for years or decades, letting compounding do the work. Value investing, made famous by Warren Buffett, involves hunting for stocks, trading below their intrinsic value. The patient hunt for bargains. Growth investing focuses on companies expected to expand rapidly, even if the stock already looks expensive. The bet is that future earnings will justify today's price. Dividend investing targets companies that consistently pay shareholders. Great for income, especially in retirement. Day trading involves buying and selling within the same day. Fast, intense, and high risk. Day traders live on small price movements and make multiple trades daily. Swing trading is more relaxed, holding positions for days or weeks, catching medium-term price moves. Momentum trading means riding stocks that are already rising fast, hoping the trend continues. Contrarian investing is the opposite, buying when others are fearful, selling when everyone else is excited. Technical analysis is the practice of studying price charts and patterns to predict where a stock might go next. A moving average smooths out price data over a set period, like 50 or 200 days, so you can see the overall trend without getting distracted by daily noise. The MACD, Moving Average Convergence Divergence, tracks the relationship between two moving averages to spot shifts in a stock's momentum. Is it picking up speed or slowing down? The RSI, Relative Strength Index, runs from 0 to 100. Above 70 often signals a stock is overbought and might be due for a pullback. Below 30 suggests it may be oversold and could bounce. Support is a price level where a stock tends to stop falling and bounce. Think of it as a floor. Resistance is the opposite, a ceiling the stock keeps struggling to break through. A breakout happens when a stock finally pushes through resistance or drops through support, often on high volume. This can signal the start of a new trend. Fibonacci retracement is a tool traders use to identify potential support and resistance levels based on key percentage ratios derived from the Fibonacci number sequence. After a big price move, traders use these levels to spot where the stock might pause or reverse. Candlestick charts show the open, high, low, and close price for a given time period. Each candle tells a story about what buyers and sellers did during that session. Traders look for specific candlestick patterns as signals. Fundamental analysis, by contrast, ignores charts entirely. It focuses on the actual business: revenue, earnings, competition, management quality, and long-term growth potential. Most long-term investors use fundamental analysis to decide what to buy, and technical analysis to decide when. Here's where things get spicy. Short selling, or shorting, is when you borrow shares, sell them immediately, and hope the price drops so you can buy them back cheaper and pocket the difference. It's betting against a stock. The risk? If the stock goes up instead, your losses are theoretically unlimited. A short squeeze is what happens when a heavily shorted stock suddenly spikes. Short sellers are forced to buy shares quickly to cut losses, which pushes the price up even more. This creates a feedback loop. GameStop in 2021 is the most famous modern example. Leverage means borrowing money from your broker to invest more than you actually have. It magnifies both gains and losses. Margin accounts are what allow you to use leverage. A market bubble forms when prices rise far above any reasonable measure of actual value, driven by hype, speculation, and fear of missing out. Bubbles always pop. The dot-com bubble, the 2008 housing bubble, history is full of them. FOMO, fear of missing out, is one of the biggest emotional traps in investing. It's what makes people buy a surging stock at the top without doing any research. When everyone's talking about a stock, that's often the worst time to buy. A pump and dump is a scheme where bad actors hype up a stock with false or exaggerated claims, wait for retail investors to pile in and drive up the price, then sell their shares and disappear, leaving everyone else with losses. Common with penny stocks and crypto. Insider trading is when someone trades based on private, non-public information, like a company executive knowing about an acquisition before it's announced. It's illegal. Diversification is the antidote to most of these risks. Spreading your money across different stocks, sectors, and asset types means one bad bet doesn't blow up your whole portfolio. Alpha measures how much a portfolio outperforms the overall market. Beta measures how sensitive your portfolio is to market swings. A beta above 1 means you move more than the market. Below 1, you're more stable. The Sharpe ratio tells you how much return you're getting for the risk you're taking. Higher is better. It means your gains aren't just the result of reckless risk-taking. Dollar cost averaging was mentioned earlier, but it's worth reinforcing. Investing a fixed amount regularly over time, regardless of price, is one of the most proven ways to build wealth without trying to time the market. And that's the language of the stock market. Demystified. Look, nobody learns all of this in one sitting. But now you have the vocabulary. The next time someone mentions a PE ratio, a short squeeze, or a bear market, you'll know exactly what they mean. Investing isn't about being the smartest person in the room. It's about making informed decisions, staying patient, and not panicking when things get bumpy, because they always do. If this video helped you, hit the like button. It genuinely helps more people find this content.